Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's a very great privilege as well as learning opportunity for us to host the U.S. launch of the 2023 OECD Going for Growth report. I think most of you are aware of this report as one of the flagship products of the OECD, and deservedly so. The Peterson Institute has hosted a number of these U.S. launches, going back, I believe, to the first Going for Growth report 20-some-odd years ago, when Glenn Hubbard was chair of the U.S. Council of Economic Advisors and working with the OECD leadership at that time. We've been friends and colleagues with a number of people at the OECD through the years, and that continues to today. But beyond the name dropping, it's the substance that makes the Going for Growth report stand out. The OECD, as we all know, born of the Marshall Plan and the high-income economies sort of club and think tank, has dominated the comparative study of the interaction between structural factors and macroeconomic outcomes. They have combined country studies with cross-national studies and thematic studies. And what's great about Going for Growth, which I guess is formally biannual, right, is that it's an opportunity to bring those work streams together and really come out with a focused program for the high-income economies and for the world. And in particular, this year, the 2023 report focuses on policy reforms to accelerate the transition to a green economy while avoiding fragmentation of the world's trading system. That's a mission all of us at Peterson Institute are well behind, that combination, and that's a mission that I hope everyone on this webcast and throughout the world can support. So as a result, we are going to be having a double session today, starting with a panel on the green transition chaired by my colleague Cullen Hendricks, who will give particular fuller introductions to Feliz Unsal, Jean Pisani-Perry, and Swami Venkataraman. I will just note that Dr. Unsal, Feliz, has been a colleague of ours for a long time and reached out to coordinate this project with us, and we're grateful to her for doing that. After a short break, we'll have a second panel on global value chains. Again, this is drawing on and presenting the work of the OECD team as published in the Going for Growth report, but then discussed with both internal Peterson fellows and as well as distinguished private sector people, of which Swami was from Moody's. On global value chain, we're going to have, moderated by our house expert, Chad Bown, we're going to have Douglas Sutherland from the OECD, Phil Levy from Flexport, the global logistics company, Han-Ku Yo, a new senior fellow at the Peterson Institute, and Mary Lovely. So this is going to be a very substance-filled exposition, and I intend to learn a lot, and I hope you all will too. But first, let me introduce, to give the broader context of the report, Luiz de Mello. Luiz is the director of the Policy Studies Branch at the Economics Department of the OECD. Together with the teams, he has been working on issues of structural policy surveillance, short and long-term economic outlooks, public finance and macroeconomic policy analysis. All of these work streams come together in his branch of the Economics Department. Previously, Luiz has had a career in senior positions at the OECD, including Deputy Director of the Public Governance Directorate and Chief of Staff and Counselor to the Chief Economist. He, prior to that, worked at the Fiscal Affairs Department of the International Monetary Fund, where, of course, has been a training ground and jumping off point for many distinguished public servants through the years. So with that, let me welcome Luiz, and thereby officially the OECD to the Peterson stage. Thank you.
Thank you very much, Adam, for your very kind words. It's always a pleasure to be back at Peterson, and especially for Going for Growth. You know Going for Growth probably better than me, so you've seen it from the very beginning, so I feel very comfortable talking about it with you and with colleagues here today. It's obviously impossible to do justice to this publication in just a few minutes, so what I'll try to do is essentially to whet your appetite, really, so that you can go and take a look at the publication to see what we've covered this time around. As Adam mentioned, we started off, putting this exercise together about 20 years ago. And I'd like to start this with one chart, which is this one, because that's the chart that motivated the launch of Going for Growth 20 years ago. In 2005, if you look at the bar of 2005 there, you see that the motivation for the publication in those days was, this gradual decline in the growth rate of potential output among OECD countries. Well, sadly, we are still in the same situation 20 years on. There was obviously a bit of an uptake since the global financial crisis, but what has saved the day since has been essentially the fairly considerable resilience of employment. It's employment that has lifted potential growth in the OECD area since the global crisis. The other components, if you look at TFP, which is the very worrying trend there, but also capital intensity, those have been gradually declining since the turn of the century. So, on the one hand, we are happy that there is a reason to continue Going for Growth, but also it's a very important challenge for policymakers to see, what we can do to change that situation. Given that we are in a complicated world, that we have lots of headwinds coming from very adverse demographics, we have climate change, we have lots of other mega trends that are coloring the outlook. A word about Going for Growth. So what is it? Essentially, it is the benchmarking exercise that we do at the OECD. It is a publication that we put out every 2 years, but it's based on an exercise that consists essentially of looking at policy outcomes across a variety of policy areas and policy indicators or metrics that could measure the stance of policy in those areas. And then we have an algorithm that basically compares those outcomes to policy settings. And on the basis of that, we identify countries that are close to the frontier and countries that are far from the frontier. And all that is done at the cross-country level, but also informed by our dialogue on a bilateral basis, country by country, so that we can learn not only what we get from the cross-country, if you want, top-down perspective, but also what comes out of the analysis of individual countries. So in a nutshell, that's what Going for Growth does. But what we try to do as well in each edition is to look at different topics that might be of interest given challenges that the global economy might be facing around the time of publication of the work. So you will see, and that's the subject of one of the panels, this whole idea about globalization, value chains, and so on. So what in particular do we look at in this edition? Well, obviously the underlying reason for this, as I mentioned, is this gradual decline in potential growth in the OECD economy. So we're still looking at policy obstacles that might be removed through action to lift potential growth. But we also took the opportunity of the pandemic to look at the experience of the policy measures that were put in place at that time to support households and firms, and see what we could learn in terms of what the policy messages might be if the world is confronted with another shock of that type and magnitude. We also looked at decarbonization efforts to attain the climate change targets that have been agreed internationally. And we also looked a bit at the digital transformation through which our economies are going. So just a few words about that. Let me start with the issue about potential growth. So I mentioned to you that employment is what has been saving the day since the global financial crisis. But we see in many OECD countries that there is still a lot of gaps that could be filled, a lot of people who are outside the labor force or that are not employed to their full potential. If you look at gender gaps, for example, the OECD area as a whole still has on average a gap between employment rates of males and females to the tune of 10%. See the countries to the right of this chart with substantially larger gaps there. But that illustrates essentially one segment of the labor market where more could be done through policy action. You could look at a similar chart for gaps in employment between, say, prime age individuals and older workers. So basically a story of persistent employment gaps that could be, again, solved through policy action on a country-by-country basis. The other aspect that I mentioned, the capital intensity of production that has also been trending down. If you look, for example, the contribution to potential per capita GDP growth of increases in the capital stock per worker, well, about 20 years ago, that contribution was to the tune of 0.6 percentage points. Now we're talking about a third of that. So another subcomponent of potential growth that has been trending down and that requires policy action as well. A word on the pandemic, which was the second bullet I had in that previous slide. What we saw is that in terms of protection of firms, many countries essentially introduced credit guarantees or other mechanisms in the majority of OECD areas, the OECD area. Many of those support schemes were lifted as the economies were opening up and the recovery was taking hold. Our analysis shows that those programs were not too bad in terms of, they were good at preventing, bankruptcies and destruction of capital during the pandemic, and they were lifted at a time that didn't impede the sort of productivity enhancing reallocation that was needed in the recovery. We looked at the same in terms of the furlough programs, all the job guarantees, all the different mechanisms that were put in place, and we also find that by and large they were good at maintaining attachment of workers to the labor force, to employment and jobs. And they didn't seem to, on the basis of information that we have up to now, to have been too disruptive in terms of preventing reallocation. But what was interesting for us to see is that social protection schemes still vary a lot across OECD countries. If you take, for instance, minimum income support, you can see from the chart that in the average OECD country, we are talking about a third of household incomes that are essentially associated with a variety of support schemes that are in place, despite this huge variation across countries. If we looked at the targeting of support, that was very important. A lot of the discussions in Europe, at least given the severity of the energy price shock that happened last year. If we look at the targeting of some of those programs, then we see again that there is a lot that can be done in terms of making sure that that targeting is improved. If you look at the average OECD country, about the same share of cash transfers goes to the to the highest income quintile as the share that goes to the bottom income quintile. So, options that are available to countries to improve that targeting as a way of, making social support more effective are discussed in this publication as well. And then the third item we looked at was the digital transformation. And the question was, are countries prepared for that? Do they have the conditions in place, the policy incentives in place? Do firms have the capabilities that are needed to make the most of the digital transformation? Just to illustrate the situation in terms of selective technologies, digital technologies, and enterprise-level adoption of those technologies, you see a very different picture again among countries. With relatively low levels of adoption, as you move from left to right in this chart, and as we go from relatively less sophisticated digital technologies to more sophisticated digital technologies on the right. So a lot of scope as well to make sure that firms have access, adopt those technologies. The point we've been making there is that, of course, access to broadband, to basic ICT technology is a necessary condition for that. If you don't have that, then obviously firms will find it very difficult to benefit from those technological developments. But also what is needed is a combination of incentives, so right regulatory measures that increase contestability in those markets, make it easier for firms to enter those sectors, as well as capabilities. And in terms of capabilities, one element that comes up in our analysis is that the quality, the skills at the management level in different enterprises is a very powerful determinant of the overall uptake of digital technologies at the firm level. So the report also discusses a few options to make sure that countries work both on incentives and on capabilities. And I will end up with this chart, which is probably one of the most let's say, illustrative ones of the need to prepare for climate change. This is essentially the International Energy Agency, a chart that I think is very interesting. If you compare the red lines, which is a number of emissions in the baseline model or business as usual model or scenario, and the blue line, which is what would be needed to achieve net zero emissions by mid-century, so in line with the Paris Agreement, you see that we're still some way from moving from red to blue. The OECD has been spending quite a lot of time on understanding that transition, making sure that there are policies that can put in place for the transition to be as smooth as possible, while at the same time, making sure that it creates opportunities for productivity gains, which would be, a way of, if you want, looking for win-win solutions or policy options to achieve progress in terms of the climate transition, but also, making sure that we can go back to that original chart and make sure that the uptick in productivity growth that we're seeing at the moment, can be sustained and increased over time. So again, these have been just very, very high level, if you want, just flying very, very high above the trees. But hopefully some of the charts are scary enough that you will have an interest in going back to the publication and see what can be done to address some of those challenges. But thanks, and thanks, Adam, very much again for hosting us today. Great pleasure to be back. Thanks.
So let me call upon Cullen Hendricks and the speakers on the first panel to pick up where Luiz left off on climate change and green transition. Thank you very much.
Thank you and good morning. I'd like to add my welcome to Adam's expressed earlier. My name is Cullen Hendricks. I'm a senior fellow here at the Peterson Institute. This session discusses policies to attempt to steer the green transition, boost green investment, and ease the allocation of resources towards green technological solutions while addressing the associated costs for businesses and workers. That sounds to me like quite a tall order to achieve all of those goals simultaneously, but it is one indeed we must fill. And it will be tackled today by an incredibly well-positioned panel to discuss these issues as they are discussed in the report. First off, we're going to be hearing from Phyllis Unseld, and she's the head of Structural Policy Analysis and Division at the Economics Department at the OECD. Previously, she worked at the IMF here in Washington for over 10 years, leading various policy and research initiatives and country missions. She also worked as a financial sector at the Financial Sector Advisory Center, at the World Bank between 2015 and 2017. She will be giving the lead-off presentation, and then we will be hearing, I think, some fascinating reflections and further comments from two other speakers. First will be Jean Pisani-Ferry, who's my colleague here at the Peterson Institute. He's a non-resident senior fellow because he tends to spend a lot of his time in Europe, where he's had a distinguished career. He holds the Tommaso Padua-Schioppa Chair at the European University Institute in Florence and is a senior fellow at Bruegel, a European think tank. He's also the author of a fascinating policy brief that's now a couple of years old, but I think is directly relevant for what we're going to be talking about today, entitled Climate Policy is Macroeconomic policy. So thank you, Jean. And then last but certainly not least, we have Swami Venkataraman, who's the Associate Managing Director in Moody's Environmental, Social, and Governance Group. He manages a global team of analysts responsible for the development of analytic methodologies for ESG assessments and scores for the integration of ESG considerations into Moody's credit ratings and research across all asset classes. I'm incredibly excited to be hearing from all of you this morning. Thank you, Phyllis. The floor is yours.
Thanks, Colin, for the great introduction, and good morning, everybody. It's my honor to be here with you today to discuss such an important topic. And I would like to start by thanking our Peterson colleagues and especially Adam Posen for giving us this opportunity to present 2023 edition of our flagship publication, Going for Growth. As you know, decarbonizing faster to meet the climate change targets is the dominating challenge of our time. As Luiz mentioned earlier, by adopting a coherent climate policy along strong structural reforms, we can address the climate crisis, which we know is urgent, but also can improve our energy security and perhaps promote our resource efficiency and growth. But this requires bold and multifaceted policy action, including carbon pricing, and the need to create right incentives for green private investment. At the same time, we need to make sure that this transition cost, both for businesses and workers, are mitigated. This is what my remarks will focus on today. This is the scary graph that Luiz just put together, but I think there's a point to indicate again. Following the 2015 Paris Agreement, many countries have committed to ambitious net zero emission targets by 2050. In order to reach emissions levels that are consistent with limiting the increase in global temperature to 1.5 compared to the pre-industrial levels, there is a pressing need to cut global emissions by more than 7% annually leading up to 2030. The estimates from the International Energy Agency, which you see here today, are concerning. The graph reveals that a glaring discrepancy between the stated objectives and pledges, marked by red and yellow lines, and the required path, which is the blue line. Overall, it's clear that the goal of net zero emissions by mid-century is difficult to attain unless much more is done. Now, in the latest edition of the OECD's Going for Growth, which we are launching today, has a distinct focus on the green transition. The report outlines policy priorities for each country derived from both quantitative and qualitative analysis. Here, each box represents the percentage of recommendations and their intensity. So as you can see, the clear message that emerges from this exercise for this time around is that there are three important policy categories which we consider key in climate transition. The first is increasing the scope and level of carbon pricing. The second one is boosting green investment. And finally, strengthening regulations, standards, and institutions to facilitate emission reductions. Obviously, the best combinations of these three sets of policies will depend on countries' economic structures, social preferences, as well as their fiscal space. Politics will come to play in terms of what is feasible to do quickly. Nevertheless, we think it's useful to look at what stands out as key policy priorities for climate transition. First, carbon pricing stands as a powerful tool in climate change mitigation. By pricing emissions, we deter the production and consumption of carbon-intensive goods, foster energy efficiency, and signal a clear path of investments in low-carbon technologies. Now, we have some evidence that carbon pricing is working. For example, after the United Kingdom added a carbon price floor to EU ETS prices in the electricity sector in 2013, emissions decreased by 53% within 5 years, and the share of coal in generation fell from 37% to 2%. Yet, many countries fall short in providing strong price signals. As illustrated in this graph, among 44 OECD and G20 countries, which are responsible for about 80% of global emissions, a mere 20% of emissions are priced above 60 euro per ton of CO2. This is significantly below the estimated social cost of carbon anyways, but we are even much below that. Additionally, a credible path of price hikes essential for genuine progress remains absent. Of course, carbon pricing is not the only policy tool that we have. Regulations such as requirements for energy renovations, emissions tracking, and green certification can effectively complement carbon pricing when fossil fuel demand remains unresponsive to price signals. A clear and predictable regulatory environment can not only reduce emissions directly, but also enhance the effect of pricing measures and promotes low-carbon options. Now, there is a growing stringency of environmental policies over the last 3 decades, as you can see in this graph. Here, we have the contribution of market-based policies that are such as CO2 trading schemes or other emission taxes, non-market-based policies such as performance standards and emission limit values, and technology support policies such as R&D and renewable energy support, which all goes into play in the OECD's environmental policy stringency indicator. Now, it seems like there have been a lot of increase over the last 30 years. However, our research estimates that in order to meet the climate goals, the rise in the regulatory stringency in the coming years should mirror what the OECD countries achieved in the last 20 years. But stronger regulations require careful design. As emphasized in the Going for Growth, regulatory frameworks should be designed with an eye on energy security, accounting for challenges like asset decommissioning and repurposing to avoid supply disruptions. Now, in the face of this existential challenge, we do really need rapid and very large-scale changes across economies. Achieving carbon neutrality demands expansive investments. The International Energy Agency projects that by 2030, global annual energy investments must surge to 4.5% of the world's GDP, that's about $4 trillion, from 1.3 trillion, which we currently have. A significant portion of this investment will need to be directed toward electrification and modernizing electricity infrastructure. At the time of high levels of public debt across many OECD countries, governments will need to find ways of giving a priority to green public investment. There is a potential to involve, of course, the obvious involve institutional investors such as pension funds, insurance companies, and asset managers. However, although there have been an increase over the years, as you can see from here, between 2013 and 2020 on the right axis, the numbers in the year 2020 on the left axis are actually still very small. Indeed, the contribution of green infrastructure financing remained relatively minimal, tapping into just 10% of their potential so far. Now, this brings me the role for private green investment. Obviously, private investment and innovation has a central role to play in accelerating green transition. Indeed, a very large share of green investments, estimated as 70% by the International Energy Agency, will need to come from private sector. So it is clear that we need to understand what's going on there and what type of investments governments can create. A simple look at the firm-level data, as you see in these charts, show that the emission intensity has declined over the last 2 decades, and this has gone hand in hand with the increase in green investment. This is observed both in European countries and in North America. Now, green private investment, however, vary across sectors and investment type. From the chart on the left, we can see that most energy-intensive sectors invest more in low-carbon technologies, which points towards the effectiveness of environmental policies. But it varies. For example, it remains still very low in construction sector, which is among the heavy polluters. The type of investment also matters. On the right, we see that firms have been less likely to invest in integrated technologies, the ones that change the way of production, compared to end-of-pipe solutions, those simply add on the production process, like filters. This is likely because the integrated technologies, which are found in the literature to be more productive, involve often larger initial upfront costs, making them more difficult to finance. This brings us the question on whether green investment can bolster firm productivity and ultimately growth while also reducing emissions. We did some further research on this. Of course, the efficiency gains on investment and innovation may take some time to materialize, while the costs related to green investments would need to be immediately supported by the firms. When investigating the effect of a mild energy price shock, we took a look at how firms actually adjust to these shocks. Here, I present a change of at least about 10% price increase or one standard price increase in energy prices. Although, of course, this is a short-lived shock, we could see that the firms adjust quite well to the extent that after 3 years, we do not observe a negative impact on productivity. However, these gains are not symmetric. In the right figure, we show, for instance, that these gains are absent in the most energy-intensive sectors, at least over a span of 5 years. Other firm characteristics also play a role. Firms holding a larger cash buffer experience a milder decline in productivity in the short term, as having accessible liquid assets enabled them to more effectively absorb rising input costs. This implies that smaller firms with the limited access to finance may need to be supported. Conversely, firms that traditionally depend on external financing feel a more pronounced impact, likely due to challenges in securing sufficient liquidity to offset the shock. Indeed, like other periods of large structural change, the process of green transition may create winners and losers. But we need to understand the distributional impacts and make sure that we address them. Uncompensated climate change policies, in fact, tend to be regressive. Households with low income, low educational levels, and weak attachment to labor market may be particularly vulnerable to structural changes induced by mitigation policies. In this graph, we have some evidence from the United States. On the very left, we present a scenario where the revenues from a carbon tax is returned to households via lump sum rebates. In the middle, we present a scenario where the revenues used to cut taxes on the capital income, and on the very right, there's a scenario where revenues used to cut taxes on labor income. You could see that all these different policy options have very different implications for people in different income groups. Recycling revenue can therefore counteract adverse distributional consequences, although explicit revenue earmarking is generally discouraged as it creates spending rigidities and priorities. Going for Growth recommends a tax shift where revenue from environmental pricing replaces revenue from labor income taxes or targeted transfers to households. At the same time, addressing these distributional consequences may also provide and enhance public support and trust for environmental policies. An OECD survey from the United States reveals that Americans generally view climate policies less favorably than the respondents from other countries in the study. Yet the design of these policies play a key role in public perception. For instance, opposition to a carbon tax in the United States diminishes significantly if its revenue is channeled into infrastructure development or subsidies for low-carbon technologies. So indeed, we need to make sure that the climate policies are communicated and understood within a comprehensive transition strategy, which is also understood to be fair. We need to outline how climate initiatives can coexist with job creation and sustained growth. Again, the green transition can stimulate job growth in certain sectors and regions. However, there may be some regions and sectors with high carbon sensitivities that may face challenges. To ensure an inclusive shift, supporting measures like education, training, skill development are all essential to prepare the workforce for green jobs as well as social protection systems. This underscores how various policy reform priorities identified in this edition of Going for Growth come together in a complementary way to support climate transition. This brings me to the conclusion. Going for Growth outlines key policy reform priorities to achieve emission reduction targets in 3 distinct areas. At the heart of this strategy is the pricing of emissions, emphasizing clear and uniform price levels and credible paths for increase. At the same time, we acknowledge that the regulation plays a key role in the policy mix, with implications energy security must be carefully assessed. And for unlocking private green investment for more productive integrated technologies, lifting financial barriers, especially for small firms, could be considered. And at the end of all this, in order to maintain and enhance public trust and backing, and to mitigate the impact of climate transition on firms, businesses, or individuals, governments may need to consider the distribution effect in the policy design ex ante and address them when needed ex post. I will stop here. Thanks.
Okay, it's a great pleasure to have the opportunity to to speak after Phyllis and Luis. And I'd like really to congratulate them and to congratulate the OECD for putting climate at the core of this Going for Growth exercise. You know, I'm old enough to remember the launch of Going for Growth. It's been a flagship report. It has addressed all sorts of impediments to growth. And now it's really good that these climate issues, which are creating all sorts of confusing discussions about the implication for growth. I'm referring to the degrowth type of view of things. It's good to have it analyzed in a framework where there is really an analytical framework behind. Now, that being said, I have a few comments to make, and I'll organize them around 4 points. The first is that the outlook is not as grim as it seems. Second, that the future emissions depend more and more on what's happening in developing countries, which for these reasons put the question of growth really at the forefront, because those countries, they have an agenda, they have a priority of development, and the question of whether the trade-off between growth and development is central. And lastly, I'll make a comment on carbon pricing, saying that, there shouldn't be too much hope in the development of carbon pricing. Now, you remember the graph that Phyllis presented, and Luis actually presented the same, in which you compare the emissions with the steps, stated policies scenario, and you see there's a big gap. This is true. I'm not disputing that. what I want to emphasize is that the Paris Agreement has had some significant effect. That's from the International Energy Agency. That's for the power sector. And the emissions have gone down significantly since the Paris Agreement for all sorts of reasons. And so the STEPS scenario gives a stabilization of emission at the level of 2015, which is already an achievement, and that shouldn't be hidden by this view that the actions fall short of commitments. Now, there are a number of other good news. For example, if you look at the projections that are made each year by the PIIE about the deployment of green technologies, wind and solar especially, and electric cars, each year they revise upward the forecast they were making. So for 2030, now we are far above. For example, wind was expected in 2017 to represent 5% of total power supply in the world. Now it's 15%. So multiplication by 3, which is obviously there are other harder to abate sector, but those are really good news. And there was a lot of discussion about the projection to 2050 and the fact that the assumption made was that technologies would develop that were not yet mature. So it was about 50% of the technologies that were developed in 2021 in the net zero scenario of 21. It was considered that about half of the technologies were not yet at a mature stage. Now, the same statistic, the same analysis replicated 3 years later, or 2 years and a half later, it's down to 1/3. So again, this is good news. So I'm not, I don't want to play the cheerleader, but I think it's so easy to be grim that I thought I wanted to emphasize that. Okay, now on the future, the emissions depend more and more on what's going on in the developing countries. So this is an interesting graph that I took from a study by your colleagues, which is how much of the emissions in 2030 will come from the 3 country groups, the high-income countries, the middle-income countries, and the low-income countries, and what are the corresponding pledges on average by those 3 groups of countries. And what you're seeing here is that on the left, you have the high-income countries where there is a significant cut from the business-as-usual scenario. There is less of a cut in the 2 other groups. But what I find particularly striking is that really a lot depends on what's happening on the right part of the graph, the middle part and the right part of the graph. So in countries that are less developed, and therefore what's happening in the advanced countries certainly will not be enough. Now, on China, which is part of the middle income group, China, it's easy to be pessimistic because China continues to add carbon-powered plant each year, but it's in fact greening very fast. there's a mismatch between supply and demand. The supply of green electricity is limited. The demand of electricity rises very, very fast. And therefore, they're continuing to rely marginally on carbon-powered plant. Now, if you look at the composition of supply and the change between 21 and 22, you see that most of the new supply is green, actually. And there's a little margin which is still brown, which consists of coal and other fossil fuels. But it's really decreasing, which indicates that China emission will peak, at least in the power sector, very soon. Now, why is climate becoming a development issue? Because those are the same numbers that were presented in the graph. Simply, if you look at what the total emissions, what will be the total evolution of total emission by 2030 compared to 2020, in the high-income countries, they will go down by 32%, or the pledges actually imply a decline by 32%. In the low-income countries, they imply an increase by 36%. So which means that action is urgently needed for those countries. And as I said before, those are countries that cannot be asked to choose between climate and growth. So the question is there a trade-off? I think we have to be honest as economists. I mean, we have to, it's easy to sort of work out, scenarios in which you can have both outcomes in terms of reducing emissions and achieving growth. But the fundamental mechanisms through which these changes take place is a mechanism that implies, in the short term, a real trade-off between growth and climate change mitigation. The reason being that this climate change mitigation, the mechanism is fundamentally a mechanism that relies on investment, and this investment is not an investment that increases potential output growth. It's an investment that's meant to substitute capital for fossil fuels. And let me show this graph, which I think is a very clear illustration of that, which I took from the Climate Change Committee, the UK Climate Change Committee. So above the line, you have the investment in the net zero scenario. And below the line, you have the savings on fossil fuels costs, on OPEX. So you have a lot of CapEx upfront. This represents about 2% of GDP, right? And the OPEX savings, they come later. The implication is that this is not an investment that's going to increase potential output. This is an investment that's going to be devoted to reducing your reliance on fossil fuels. So you're getting the same amount of electricity, but it requires more capital. And since it requires more capital, you've got to invest more. But that means, by the same token, that there is no potentially positive effect on potential output. So in the long term, in the medium to long term, there is no growth mitigation trade-off, but we have to recognize as economists that one of the fundamental mechanisms on which this transition relies is a mechanism that involves a trade-off. Let me end on one thing about pricing. I'm all in favor of carbon pricing, but it's not happening. It's not happening. These are the prices for 21 in the EU, in the UK, in China, and in the US. And the carbon price in China and the US, in terms of the effective carbon price, is really, much below what is needed. Now, is there any intention to introduce carbon pricing in the US? No. Is there any intention to develop carbon pricing in China? Perhaps, but, to a limited extent. So I think, it's good to plea for carbon pricing, but we've got to recognize that it's not happening. It's not necessarily an issue, a major issue, because pricing is no panacea. I mean, for cars, for example, I mean, if you want, and let me end on that, if you want to give an incentive to develop electric vehicles to manufacturers, what is best? A regulation that tells them by 2035 you're not allowed to sell a new thermal combustion engine to put it on the market, or a commitment to a certain price in the future, which has limited chances of being credible. I think in this regard, regulation is much more credible. So prices are needed for certain type of decisions. We are all rational animals. We base our decision on prices. But this is by no means, this has as an implication that nothing can be done without prices. Let me end here.
Colin? They're pulling it up? Okay. Oh, there you go. Okay. So thank you. So this might, it's a slight shift of maybe focus from the last two talks. In the sense, I'm going to give in a financial sector perspective on what the transition means for companies. And I'm going to be talking about two kinds of products that Moody's has. One is what could be called a carbon transition indicator. And the other is what could be called a net zero assessment. And how are they different? So the carbon transition indicator is meant to answer a very specific question. How could credit ratings change as a result of carbon transition? And what we typically do here is we take highly exposed sectors and we focus on the one big issue for every sector. So if you take the automobile sector, the one big issue is the transition to electric vehicles. How is a company positioned on that transition? If you take oil and gas, the big issue is how can you reduce your dependence to just upstream oil and gas production or to the sale of transportation fuels? So can you diversify maybe to petrochemicals or to clean energy and hydrogen, carbon capture, and so on? Utilities, same thing. How soon can you pivot from coal and gas to renewables and other nuclear and other fuels? So we take the one big transition issue for every sector, and we look at how a company does by looking at what we call four factors that you see here. Current low carbon transition profile, which is where do you stand today, right? The second is what sort of exposure do you have to policy risk, technology risk, and market risk for the next 5 years? And in doing this, we use the IEA STEPS scenario. So there is a connection that I will bring back between the IEA scenarios that we were talking. So we look at STEPS and see where do you stand in the next 5 years, what do you need to do? The third is, how's management adapting to it? What actions are you taking to reposition the company in a direction that minimizes the risk of carbon transition? Again, up to about 5 years. And then there is a long-term component, a long-term rapid transition scenario. Typically, we look around 10 to 15 years. And I'll come to why maybe in the discussion. But when we do the long-term rapid transition, we are still only focused on the IEA APS, which is the announced pledges scenario, which we know over the long term aligns with about 1.7, 1.8 degrees of temperature increase. Right? And the way we have structured this is that we are using publicly available data. Maybe subscription data, not just corporate disclosures, but there are data providers for each sector who provide asset-level operating information about these sectors. And that it allows us to assess stranded risk for the various companies and the assets that they have, which really goes into this component D, the long-term. It's all about looking at stranded asset risk. So the way we use this is an input into our rating process. When we take a company into the credit rating committee, we look at where does the company stand on this 10-point scale that we have for carbon transition. And I can show you, this is where all these different sectors stand. You see the CT1 to CT10 is a scale. And you see various categories of various sectors, from autos to utilities, airlines, oil and gas, refining, steel, shipping, all the big, and you see the distribution. What's immediately notable, I would say, are two things. One, we can distinguish between companies in any sector. They're not all the same. Even in hard-to-abate sectors like steel, and airlines and shipping, there is lesser distinction perhaps, but there still is some distinction. You can look at these companies and differentiate between them. And then the other, of course, is automobiles and utilities are the most advanced in terms of the ability to transition, and so that's where you see the greatest diversity of scores. The other interesting thing is the bottom, you see the square, the black square is sort of the newer scores. When I say new, it's more recent, like maybe a month or two ago, and then the triangle is maybe a year ago, right? So every year we try to update this, and you see some interesting trends, right? In the auto sector, it's actually gotten worse. What does that mean? What it basically means is there is credit risk associated with the transition. Yes, the technology is there. Yes, we can make electric cars, but there's no guarantee that consumers are going to buy the electric cars that a particular company makes, right? And so you're taking that market risk as part of the transition. So we see the transition happening successfully, but at the same time, risk could increase. Utilities is the other way around. Typically, utilities in most countries have good certainty of return on the investments that they make. So you see the risk actually going down this year compared to last year as they continue to invest on these transitions. So I'm happy to take more questions, but the main point is these type of global scenarios, particularly the IEA scenarios, they have great value. They allow you to put companies across sectors and compare them on a like-to-like basis for a given environmental outcome, right? And so that kind of input we can use into our ratings, and we make this publicly available for investors as well. I'll also spend a couple of minutes on what we mean by net zero assessments. Well, obviously the name implies we are assessing the credibility of net zero pledges and targets of companies. But it's different from the previous one in the sense the previous one, you take the one big issue and you focus on how a company is doing. This is a very detailed scope 1, scope 2, scope 3 assessment of corporates. It's also applicable to every single sector. Even sectors where we think the credit risk of carbon transition is not very significant, although there is a transition to be made. You take a company, let's say Moody's Investor Service, right? Our own business is not really exposed to carbon transition risk. There's not as much of an issue that our cash flows, our profitability, our balance sheet is going to be dramatically affected by carbon transition risk, for example. But Moody's has a net zero target by 2040, and that involves a lot of work, especially with the supply chain in getting all our suppliers to transition as well. So you can make a net zero assessment even of companies like Moody's. So that's the broad difference between the two. This is really meant not as a credit rating product. This is meant to serve investor needs for other purposes. Investors have their own net zero pledges. And how do they know where the companies in their portfolio stand? This assessment will tell them where every company is on its path to net zero, considering Scope 1, Scope 2, and Scope 3. And the most important difference from someone like SBTI that does validate targets is that we are not just looking at the target or what we call ambition. Most importantly, we look at implementation as well. What is a company doing about getting there? And it's an assessment of the credibility of their implementation plans that we think distinguishes this product from pretty much anything else in the market. By the way, this is not yet officially launched. It is coming up. We've put out a framework for comment. It's out there. We are doing a pilot study within Moody's to score a number of companies to see how well we can do this. But we look to be launching this very, very soon. So 2 tools for investors, one focused on credit, one focused on just investor portfolio management, understanding where companies are in the transition. Both based on IEA scenarios. We use steps, we use announced pledges, and this one uses the IEA net zero by 2050 scenario. So our assessment is where can we bring the Moody's expertise to bear to help the market have the tools that they need to really assess risks from carbon transition, whether it is credit risk or it is simply understanding where their portfolio is and which pledges are really credible. Thank you.
Is this thing on? Fantastic. I'd like to thank my panelists for those great introductory remarks. That was remarkable, covered a lot of ground, and I think has established a great basis for about a half an hour that we can dedicate to diving into these various themes in a little bit more detail with some question and answer. And pursuant to that, while I do have some lead-off questions for our panelists, I would like all of you to put your thinking caps on and come up with some queries so that you can push them a little bit further. There will be an opportunity in a few minutes here. We have I believe, a standing mic. There may be a roving mic as well. There will be a microphone in your immediate vicinity. Thank you, Sarah. Okay, so we've got both. So we've got options here. Well, first off, I'd just like to, again, congratulate your team on this excellent report. Anything that I think that we wish to come to pass in the macro sense with respect to green transitions is, of course, going to be, in large part, the product of the micro-level, kind of firm-level decisions about investments in reducing their carbon footprint and tackling some of these challenges and the trade-offs that Jean foregrounded. And so my first question to you, Phyllis, is going to be kind of in the theme of these sort of distributional kind of challenges. And that is that we seem to be seeing that a lot of larger firms are the ones who are responsible for the lion's share of investments in decarbonizing their supply chains and their own business activities. That's, of course, welcome, but it also means that smaller and medium-sized enterprises are falling behind, at least in a relative sense, and that this can have knock-on effects for their competitiveness, driving greater market concentration, potentially in larger firms, reducing consumer choice, increasing consumer prices. And this is incredibly important in large part because small and medium-sized enterprises are crucial drivers of economic activity in precisely the kinds of communities, smaller, more rural communities, that are potentially going to be adversely affected by these green energy transitions. So I guess what I'd like to start with is what more can be done to kind of make sure that SMEs are going to remain competitive while greening their own investment profiles.
Yeah, thanks, thanks, Cullen, and thanks also for the great discussion with John and Swami. So just to repeat basically what you said, so firms will need to shoulder most of these green private transition, private investment, and all the innovation needs. Now, it's costly, and it's even costlier when you don't have financing options, which tends to be the case for smaller firms. So conceptually, when you consider and internalize the fact that firms vary in their sizes, their access to finance, their productivity, and market powers, and by the way, which all tend to be interrelated, it's obvious that the larger, more productive firms will have easier time to adjust, they will amplify their green investments, and in the process, they may amplify their productivity and expand their market power. They may also crowd out some funds for smaller firms, so increasing also the price of green investment inputs. So our research, based on available data, indeed confirms this. In addition to that, there's a path dependency, as emphasized a couple of months ago in another Peterson event on climate by Professor Aguillon. And that is something that we will also need to put into consideration. So we are talking about high upfront costs, we are talking about financing constraints, path dependencies, knowledge externalities, and and at the same time, the different companies having higher market power. So when it comes to climate, we are all very much aware of the fact that there's an externality and we address it. However, there are other externalities. These are all externalities that the policy action can react to for better outcomes and bigger outcomes. And therefore, we have a lot of different policy levers, and of course, the one is directly related to the climate action, starts from, maybe the subsidizing the firms or incentivizing the technology development. But also that at the core of it, there is the financing constraints that we know that at least that part we need to resolve to support the firms, the smaller firms, and especially the financially constrained ones, so that we need to make sure that this transition is also happening for them, because we also need small and medium firms to adjust. We cannot leave behind, also for the sake of green transition, but also that, of course, it's more broadly very important to keep the market dynamics alive, first and foremost, also from our side for productivity, because we need productivity at the end for longer-term growth. But in addition to that, there are other policies that, in terms of the structural reforms, that would help, of course, to create a healthy business environment. And of course, this starts with market-friendly competition policies, regulations, and labor market policies. We actually go very deep in this report. So, for example, by ensuring low entry barriers for firms to enter the market, pro-competitive regulations tend to encourage entrepreneurship, tend to encourage investment in new technologies, and maybe some risk-taking. At the same time, there's the insolvency frameworks. If they are improved, they can also add market dynamism and tend to improve competition. So we all want the path to the non-zero to happen, but we also want that how we get there without killing all the small, medium enterprises. So I think that would be it.
Thank you, Phyllis. Unless my memory is incorrect, I believe you were the first person at today's event to broach the S word, talking about subsidies. And that's something I'd definitely like to come back to.
Well, somebody had to come to it.
Exactly. We will definitely bring that back onto the table in a few moments here, because I'd like to get all of our panelists' perspectives, actually, on that particular suite of policy levers. But before we get there, I've got a softball question for my colleague, Jean, which should be relatively straightforward and easy to answer. We find ourselves at a moment where we have comparatively high interest rates and comparatively high geopolitical risk. You could argue that we're facing both the highest interest rate environment and the highest level of systemic geopolitical risk that we've seen in decades, at the same time that we know that we need hundreds of billions, if not trillions of dollars of capital mobilized. And we know that not just because of what's called for in the OECD report, but also we know that in advance, many of the reports have been issued in advance of COP28. So Jean, my easy question to you is, what can be done to simultaneously address growing government debt, which is going on in the background as well, while providing adequate financing for green transitions amidst market and fundamental geopolitical uncertainty?
Thank you for the easy question.
You're welcome.
I think the answer, in short, is be selective. I mean, use debt to finance what's there is no substitute to debt for. You spoke of massive investment needs. The fiscal monitor of the IMF, released a few days ago, comes up with this number that the cost of scaling up existing climate policies to meet the challenge would imply a rise in public debt ratio by something like 50 percentage point of GDP. So that's absolutely massive, and that's certainly not something you can actually test the markets with. So what can be done? Be selective, that means that part of the investment has to be done by the private sector. Part of the private sector is perfectly able to do this investment, so there is no need there for public support. Public support should be reserved to where there is no substitute, which means everything that is in the responsibility of the states or local governments, like public buildings, like infrastructure, like those things for which you can't ask anyone to pay for it, but the public sector. Then there is a need to provide support, subsidize, as you said. The agents who are not able to finance by themselves the investments that are required. And here I'm thinking of households, because the investments that are required, they represent a heavy burden on households, and not only on low-income households, also on median-income households, significantly. And then you have all the SMEs, which are cash constrained and which need to change their track, etc. And so there is not really a substitute to public support. And so the question is, how much is it in the end, and how can it be financed? Well, I would say finance reserve debt to where debt is really the adequate instrument. Part of this investment pays off in terms of savings on fossil fuel consumption over a long period. And this is where debt, I think, is the right instrument. When there is clearly a payoff identified, and you can therefore go into debt, and you can sell to the market the fact that this is a necessary transition and it has to be financed by debt. For the rest, you have to rely on reallocation of public spending, away from actually brown spending towards green spending, and there is a lot to do there. And you have to rely on taxation. And I'm not speaking necessarily of carbon taxation. There are other ways of financing this transition. I report to the French Prime Minister, I've proposed a one-off wealth taxation that would respond to this need of financing the transition, because the transition is just a move from stage A to stage B. So it does not require permanent taxation. So that's a possibility. So again, a portfolio of instruments, debt is one of them, but debt should be reserved to certain needs.
Thank you, Jean. I would just like to underscore one of the points that you made about the importance of debt for financing these kind of goals that have much longer-term payoffs, reducing oil import bills. We can also think about that in terms of reducing exposure to geopolitical risk, and in particular the weaponization of fuel and energy markets, as we have seen in an all too acute sense in the last several years. So thank you very much for that. So Swami, you and your firm are one of the key kind of scorekeepers that's assessing these kind of risks and these issues with debt accumulation, debt sustainability that Jean has foregrounded in his discussions. How are you thinking, I guess, going into a little bit more depth than in your presentation, maybe, what this kind of green transitions are going to mean for credit ratings kind of broadly sort of defined? I mean, the macro context we've kind of elaborated. It tells us part of the story, but it doesn't really get at kind of the different kind of footing from which kind of different sort of firms, say, within a particular sector are going to be facing these kinds of challenges. So what is the Moody's perspective on trying to get some leverage on that issue? Sure.
So the carbon transition indicators, the 10-point scale that I talked about, there is a qualitative definition associated with it. And when you're at the highest end, at the 1, let's say, we're actually talking about companies whose ratings benefit from carbon transition. So they're actually better off, more sales, more profits, more profitability, if you will, in some cases. And then there's also the other extreme of the 9 and the 10 in particular, where we're actually saying this company's business model is fundamentally inconsistent with a low carbon world, meaning that just business might not exist unless the company finds a way to transition. So the credit impact could be all the way from, better than today to you're bankrupt, right? That potential is there. What we've seen, though, is companies, so far, broadly speaking, they do have time to adapt if they choose to in terms of repositioning their business model. We have seen some rating changes, not wholesale rating changes driven by this so far. But one prominent one that I often like to highlight is September 2019. I remember the date quite well because it was pre-pandemic. And it was in the company when talking was Ford Motor. And it's not it's not something that was caused by the pandemic. But if you look at our press release for back then, we said very clearly a combination of 2 or 3 things: large restructuring costs and a need to create a credible electric vehicle platform to position for the future, caused that downgrade took Ford from investment grade to non-investment grade. That was a pretty important move, transition there. So there are examples like this. And what I would say is there are some sectors that are much more exposed. There are certainly sectors like steel and airlines and shipping where the fundamental demand for the product is not going away. It's just a question of how you manufacture the product in a more, or offer the service in a more environmentally friendly manner. So maybe in those cases, the risk is somewhat different from situations like oil and gas or refining and so on, utilities, where unless you transition, your business might just not exist. So I think what I would point to is the entire spectrum of possibilities exists. It's usually highly case by case. It's also geography specific. It's something I didn't quite talk about in my talk, but the other speakers really mentioned that. We are talking about OECD versus emerging markets versus high income and low income. The benefit of using the IEA scenario is precisely that. It gives you forecasts about what different regions of the world are expected to do under each of those scenarios. So our analysis is suitably nuanced as well. We do take into account what different countries are expected to be at different points in time.
Great, thank you. And if I can ask you just a quick follow-up on that. I mean, we talked a lot about kind of firm-level analysis, but presumably this has impacts for sovereign analysis as well, simply because there are countries, some of which are highly concentrated in the exports and have built their sort of political and economic structures around the export of these incredibly carbon-intensive kind of commodities. So maybe can you talk for,
yes,
you have a few words on that?
Absolutely. So we actually published a report on this. It was somewhat of more of a scenario analysis than an actual prediction, because it's hard to say when this transition happens and oil exports start going down and what the combined impact will be on not just volumes but prices, like what OPEC might do in response to it. It's all very almost game theory-like in terms of trying to predict it. But we did run a scenario where we said, what if the IEA's net zero scenario or the announced pledges scenario becomes a fact, becomes a reality? And we essentially looked at the break-even prices, roughly speaking, our expected break-even prices of different countries' oil productions, and where their sovereign rating is likely to go if those forecasts come true, under the assumption that the countries choose to maintain their social support policies. Like, in all of these countries, oil exporting countries have massive social support policies. So there are variables there. And we actually published what the impact on the rating would be. And in some cases, dramatic impacts, ratings going from A category ratings going to non-investment grade as well. So that potential is there, but it hinges on these big assumptions, right? One, timing of volume changes. How will exporters respond in terms of OECD and price adjustments? How would that respond? And most importantly, how would they respond their domestic social support policies and schemes, and how would they manage their budget around it will have a big impact on where the rating goes. But I'd be happy to share that report if that would be of interest.
That would be fantastic. And I think you've piqued Jean's interest with these comments, so please.
Okay.
Yes. I will have a very direct and simple question. Suppose a given country comes and say, I'm going to finance the transition with debt for good reasons, because this debt will actually, these investments are going to pay off in the medium term. How would you react? I mean, how do you think rating agency would react? Assuming that the case for this additional debt is a sufficiently strong one.
So usually, make sure I understand the question right. The debt is often borrowed by the corporations within these countries. So are you talking about national oil companies borrowing debt in the sense that they are government-owned?
I'm talking about sovereigns.
Yeah, but sovereigns typically borrow debt more for the adaptation side of things. When they want to adapt to changes, they can borrow debt. But countries typically, so the investments in power generation or new autos or these newer technologies is done by companies in those countries.
Absolutely, but for the renovation of public buildings, that's entirely, the public sector.
Energy efficiency, okay.
Energy efficiency, you need to invest. You need to invest in a new heating system. You need to invest in renovating buildings. We're speaking of, significant investment. What do you think would be the reaction?
Energy efficiency, typically, what we see is it is an investment that is shown to pay for itself over time. This question, to us, comes a lot more in the case of the physical risk of climate change. If countries need to do things to secure their water supply, from droughts or from salinization of seawater creeping in, or they need to, literally speaking, almost say build seawalls, or set up other ways of managing wildfires, like real public expenditure where all you're doing is trying to protect your existing GDP from harm without a lot of incremental GDP. That's the question that's being asked. It is a hard question there. There is a lot of debt. I think what we want to say is definitely that it is better that you do it than not, because the cost of losing the GDP or being affected is often more than if you borrow for the sake of securing the impact of climate change. The World Bank has talked about doing this kind of studies where they try to look at what sort of policies should they be encouraging countries to adopt in order to spend money. But I think the short answer is yes, prudent additional debt to mitigate the impact of climate change or adapt to the impacts of climate change will be, is the right direction to go. I think that usually the difficulty in these questions are the countries that are usually heavily affected are also the countries that are able to least afford additional debt in terms of being poor countries and low GDP. That's an answer is harder to, it's harder to answer on a very generic basis.
Thank you. Felice, I wanted to bring you back in on this because as we're talking about debt, this relates also to one of Jean's observations, which is a carbon tax would be wonderful. We could spend another entire panel spinning out all of the reasons why it's sort of incentive compatible and whatnot. And the United States appears to have very little interest in doing it. Our friends in China seem to have relatively little interest in doing it. And indeed, we're moving in a different direction, which is issuing debt in order to fund subsidies, going back to the S word. Your presentation did not really talk much about the role of subsidies in promoting green transitions, but I was wondering if you would be willing to kind of contextualize the S word in this discussion and what would be potentially the appropriate role for subsidies to play in promoting green transitions. And fellow panelists, you're not off the hook because depending on what Felice has to say, you'll be drawn back in on this one as well.
Thanks, Colin. So first I should say that, of course, carbon pricing remains as a very effective tool, and we have seen that it works. It brings down the emission levels, and this is it's at the center of climate transition that we shouldn't ignore. There could be some other complementary policies. Especially, we know that this in the short term, climate transition will be costly. And there will be transition costs for firms and households and in certain sectors of the economy. And as I mentioned before, there are a series of externalities that you may consider, which may justify the role for subsidies in certain occasions. And also, of course, that at the end of the day, there are political choices being made, and therefore the short-term transition costs, if in the United States, if the policy option is to minimize that, to maybe delay the climate transition a little bit, that may be their own country-specific circumstances. However, I was just listening a conference where they were also saying that some of the results from IRA on climate emission reductions are actually also very positive. I mean, we should also probably learn to look at these results all together, internalize. There are so many questions that we don't have the answers yet. So I think this is a very evolving field, and we are all shaping our policy view as we learn from the evidence.
Thank you. I think our panelists are giving us a lot of red meat or perhaps green plant-based alternatives to digest here. We have a few moments. Are there questions from the floor? Yes, please. Thank you.
Hello, thanks so much to all of you. I wanted to go to Jean, but others may have a...
Could you introduce yourself briefly? Thank you.
I'm Caroline Atkinson. I'm on the board of the Peterson Institute and was formerly, when I was in the White House, chairing the Major Economies Forum, otherwise known as the Major Emitters Forum. Anyway, I was... Of course, I'm aware of the political economy of trying to get the countries whose emissions will matter in the future to agree to ambitious goals. And I wanted to ask Jean two things. First, on your right-hand side of the low-income countries, they may be very large increases, but are they very large in absolute terms, those countries? Obviously, China, India, Brazil, Indonesia are, but the long tail, is that a large problem? And the second is, you say you can't ask the countries to choose between growth and adaptation. And I suppose part of the problem is that they don't do very well on growth either often. And is there a way to think of combining investment opportunities that may not come? I mean, obviously, India is in a different category. So those are two questions that I'd be very happy to hear people's responses to. Thanks.
Jean, do you want to go ahead and take it?
Yeah, on the first question, it's a matter of, horizon. Those countries, the developing countries, the one and the low-income countries, they don't emit much, but their share is growing, and you're not going to get to net zero without them doing, the right investments. Obviously, I'm speaking especially of India, which is in this category, but also of several African countries. So for them, and that's, to transition to your second question, I think there is an opportunity to sort of leapfrog because they they don't have a very large capital stock in general, so they could, in fact, choose by choosing rightly the investment, they could avoid the cost of transitioning from one capital stock to another one, which I think would be a positive thing to do, and which could limit the cost of the transition. Now, whether it would be conducive to adaptation at the same time is a different question, because adaptation has a lot to do with where the investment is located and what the nature of the risks.
Thank you. Other panelists, any thoughts on this one? Thank you for that question. Do we have other questions from the floor? We've got about 5 minutes, and if we have no other questions from the audience today, I have something that I could...
I have a comment on a subsidy question, though, if I may.
I would love to hear that, to be honest. Thank you.
So, I mean, I think the history clearly shows the benefit of public policies. You could call it subsidies in various ways, but public policies supporting directly the emergence of new technologies as opposed to just carbon taxes. Specifically, the European feed-in tariffs that really kick-started wind and solar growth, that then today you see where it's gone. And I think one could argue that although that was a subsidy at the time, particularly for German ratepayers, I don't know how many German representatives we have here, but it was a subsidy that they bore, but with tremendous benefits globally, as it turned out eventually. So there is often an effectiveness of those policies, which is one of the reasons why the IRA could also be similarly effective in creating demonstrations or pilot projects of new technologies and commercializing them. The other reason is I understand the attractiveness of carbon taxes or cap and trade type systems, but one of the issues there is they are very effective in a sector like power, where there cannot be leakage. You cannot produce electricity in China and import it into Europe, right? So that's one reason why it's very, very effective in the power sector. But in most other sectors, it's maybe for steel, but steel you could have leakage unless the whole world gets onto the same system. But in other industries, it's not as beneficial. So if you take autos and fuels, gasoline, for example, at $100 a ton of carbon price, your price of gasoline will go up by $1 a gallon. If you roughly compare, that's how much it would go up by. But $1 a gallon is something that the US market sees almost every year in terms of swings. We go from $2 to $3 to $4 and maybe even $5 and back, with hardly the kind of impact, at least not the kind of impact that would take you to net zero. So there is a sort of a limitation to the effectiveness of the carbon tax, cap and trade type system, especially for transportation fuels. It may be more so for steel and others if you can truly make it a global system. But where you need to develop a whole new technology, there are many other constraints, such as technology development, willingness to engage in a pilot project, and so on, that might make more targeted actions more effective.
Thank you. Any response to that, please?
Yeah. Just on the technology angle, so I completely agree that, of course, in certain and solar is a perfect example. One thing, though, is that, and actually Adam Posen touched that in his foreign policy piece very recently, that so giving a subsidy to improve, to cultivate certain technology is a great idea. But then you need to give that, even a Japanese firms comes to you or a Korean firm comes to you, and not just American firms comes to you. So there's a slight difference there that we need to make sure that if it's for technology development, it applies to everybody. And it seems like a really great idea to cultivate research, especially for such a challenge that we are all facing today. Yeah.
Absolutely.
All right. Well, I believe that brings us as close to time as we can get without sneaking in one more question. I would have loved to have been able to do so. This has been a fascinating panel, and I'm really glad we were able to have this wonderful conversation. Please join me in thanking our panelists today for their observations. Thank you. At this point, we will be taking a brief 10-minute break. We will be reconvening at 10:45 for a second panel on global value chains. So we'll explain how we're going to get all of these innovative technologies from the various places they are made to your home or place of business.
Thank you.
You're welcome.
Okay, welcome back to the Peterson Institute for International Economics. My name is Chad Bown. I'm the Reginald Jones Senior Fellow here at Peterson. And this session is titled Reshaping Global Value Chains. It will focus on the risks of fragmenting the economic order and possible policy strategies to cushion them without eroding efficiency. So I'm going to introduce our experts of the next panel, at which I will do so in the reverse order that they will speak. So let me start with Mary Lovely. Mary Lovely is the Anthony M. Senior Fellow here at the Peterson Institute and an expert on global supply chains and China. She served as the 2022 Carnegie Chair in U.S.-China Relations with the Klug Center at the Library of Congress. Mary is a professor emeritus of economics at Syracuse University's Maxwell School of Citizenship and Public Affairs. Her current research investigates China's foreign direct investment policies, strategic reform of U.S. tariffs on China, and recent movement in global supply chains, which she will share with us today. Hanggu Yo is the former trade minister of the Republic of Korea, and he recently completed almost 3 decades of public service, yet he's still quite young. He is now my colleague here at the Peterson Institute, having joined us this summer, and has been incredibly active in the short time that he has been with us, already publishing research on industrial policy, supply chain resilience, economic security, and the international trade negotiations ongoing under the IPEF framework, as well as on the CPTPP. Dr. Phil Levy is the chief economist at Flexport, where he leads qualitative and quantitative economic research informed by public policy developments and proprietary data. Phil's research informs the market on global trade trends and helps Flexport teams make product and business strategy decisions to best serve client interests. Before Flexport, Phil spent 2 decades researching and forming global trade policy and mentoring people like me. Phil has been an incredible public servant, having twice served at the White House on the President's Council of Economic Advisors, and also was a member of the policy planning staff in the State Department. And finally, our kickoff speaker to discuss the OECD report is Douglas Sutherland, who is the head of the Structural Surveillance Division of the OECD's Economics Department. There he leads work on climate change and environmental economics, regulation and competition, labor markets and inequality, resilience and global value chains, and it looks like the list goes on and on and on. Is it basically everything outside of macro forecasting? Sounds about right. He has previously prepared the biannual OECD economic surveys and regular economic projections for Iceland, Ireland, Japan, Russia, and the United States. Douglas will turn it over to you to describe the OECD's incredibly important work, explaining how global value chains are being reshaped, why they are being reshaped, the implications of them being reshaped, and finally, if there are adverse negative unintended consequences of how global value chains are being reshaped, what policymakers can do about it. Doug, over to you.
Okay, well, thank you very much again to the Peterson Institute. I can't think of a better place to actually talk about these things. That also means that the bar is actually relatively high. But I'm also delighted that the speakers on the panel that put together are experts in the field, so I'm going to learn a lot more at the end of the presentation as well. The origins of this paper was when we were looking at the Going for Growth recommendations. There were a number of recommendations in the realm of trade, and it was often say, less developed countries. It was continuing the progress of reducing barriers to trade. And another suite of type of recommendations was really talking about regulations that impeded services trade. But there was at the same time, growing recognition that things are changing on the international arena. I didn't know so much about fluid dynamics of big ships and small pieces of water. Then we've had, as mentioned earlier, the weaponization of energy exports to Europe, and they're coming in big and repeated shocks. So this chapter is really just to complement the rest of Going for Growth by saying there's other policy issues out there that we should also be thinking about. And just to give you the, where are we? So the background, or to put it into the context, is up until recently we were thinking the slowdown of globalization was really going to be unwinding the kind of benefits that we see in the top part of this statement, of saying the traditional gains from higher levels of productivity, lower prices, the variety of goods, and also the global convergence of incomes as developing countries were integrated into the global economy and started to see their incomes rise quite rapidly. But more recently, what we're now seeing is that there's also a set of risks that we weren't really thinking about beforehand. And so we have concentrations of production in some places. Some of it is just geographically determined. There's nothing much you can do about it. Others are deliberate policy choices. Our economies are very dependent in some cases on particular countries or particular firms even. And with long, complex global value chains, there are emerging choke points, and we really don't have the ability to anticipate where they are before. So if I bring this back to what Lewis was saying right at the beginning, the Going for Growth framework is how do we lift potential per capita GDP growth? And what we're saying here now is that there may be headwinds, but is the headwinds a gentle breeze or is it a gale force storm? And so can policy help mitigate these kind of influences? Now, before I started, I just wanted to, I've been almost trading off growth and volatility, what I was saying beforehand, but theoretically and empirically, the evidence is very, very mixed. So make sure that we don't see it as necessarily an opposition, but it can be in certain cases. And you'll see in the chapter that we actually put a fair bit of emphasis on information, that governments can help the flow of information to the private sector and help identify where potential risks are coming out. But at the same time, we've got to admit a little bit of humbleness that we probably won't be able to identify them all, and the level of granularity that you need to identify emerging risks is extremely demanding. So the data may not just be there at all, so therefore you're then talking about what's a policy framework which can mitigate a risk once it avails itself. So this is a picture that I think everybody in this room is probably familiar with. What we have here on the left-hand side is a chart of what we've labeled traditional trade, which is essentially a good gets produced in one country, crosses a border and gets sold. And then the blue line is global value chain, so that production is taking place across multiple borders and ends up being sold in another country. And what you see from the 1990s up to around about the time of the global financial crisis is that global value chain trade was growing quite steadily. And since then, it's been jumping around. Well, the 50-50 share has been there more or less, a little bit of volatility here and there. On the right-hand side, this is just another way of trying to show the importance of trade and value added. And this is taking or merging two data sources to show how important it is in world GDP. And again, you see this rise until around about the time of the global financial crisis. And if you squint with your eyeball econometrics, you might say it's slightly trending down, but who knows? Yeah. So in one sense, global value chains have reached a kind of plateau. But when you shift underneath the hood a little bit and say what's been happening, and so this chart is just giving you what's been happening to import shares of different countries in the European Union, United States, and Japan. And for the European Union, a little piece of economic self-harm by one country probably explains a lot of that. Whereas you're looking at the United States and Japan, you see a growth in the importance of India and dynamic Asian economies. And certainly for the United States, you see a decline in the importance of Chinese trade. Some of that is policy related, but it's also creating a different constellation of potential shocks in the trading economy. And these are quite substantial changes of, let's say, the decline of Chinese trade for the United States of about 5 percentage points. So how can we then start addressing what are the types of risks? And I'm going to give you a couple of metrics. There's actually lots and lots out there, and they're quite confusing and may not always be consistent. For this one, we're looking at the foreign input reliance, which is thinking of how important are imports in domestic production. And it should come as no surprise that the larger economies are on the left-hand side and the small open economies are on the right-hand side. The good news, if you're thinking from geopolitical terms, is that most of the dependence amongst OECD countries is on other OECD countries. But you do have a few countries like Korea and Turkey and Greece where the import reliance from outside the OECD is noticeably higher. When you move to the industry level of analysis, then things change a little bit and become more concerning. So in this chart, which is looking at the top 5 countries, and it is of all the share of those countries in total world exports. So at the top you have computers, electronics, and optical equipment, and there you see that China alone has about 30 or 1/3 of exports in that industry. Below it, textiles, again, China over 40%. And generally you see that the concentration of exports is quite pronounced for many of these industries. When it gets to the kind of product category level, it becomes much more concerning again. So this graph is showing just the percentage of global production on certain electronics and pharmaceutical products. If you take on the top right-hand side, you have in the top bucket is antibiotics, or a certain class of antibiotics. And there you see that China alone is responsible for about 90% of global production. And there's a few other categories of antibiotics below, which China also is a very important share of their production. And I think in one case there is antibiotics in just one single factory in China. And that shows just how concentrated these dependencies can become. And then, as has been mentioned in the previous round, you also have the importance of energy in international trade. This one is looking at the import dependence, so that is net imports as a share of total domestic consumption. So on the left-hand side, maybe Luxembourg, due to its geographical location, it's integrated in the European electricity market, so it's probably not such a bad thing. But there are other countries up there, particularly Japan. It's elevated the amount of energy imports it has to import, partly because of the repercussions from Fukushima, that they had to close down the nuclear power stations. But there's also unused potential in making sure that energy or renewable energies, as the previous session was talking about, that could mitigate some of the risks that you have been exposed to a single for your energy supplies. This also brings me to maybe 2 points. The high energy import dependence of certain countries, and that was shown in Europe with the weaponization of natural gas exports, there was a tremendous demand response, that the outcomes of the elevated prices at the end of the year were not as drastic as had been anticipated, and that was partly the demand response, but there are also lots of ability to shift suppliers, shift the composition of energy supply. There was a lot of investment going on in energy-saving technologies at the same time. So the high prices led to both a demand response and also substitution away to other sectors. So this is an area where, if you're thinking about the global value chains and the resilience against it, being able to substitute is an important component of making your economies resilient. So that's the kind of idea is, as a public policymaker, what is your ambition? Are you wanting to restore status quo ante, or do you want your economy to be evolving in a ways that you won't be exposed to these shocks in the future? As just a sidestep, when I was flying over here, I was reading about the guano wars in the mid-19th century, and Congress in 1856 passed the Guano Island Act. So any American could claim an island with a significant seabird population, and that was one of their ways to make sure that they had access to what was then the fertilizer of choice. Within a couple of decades, this was all pointless because synthetic fertilizers have been invented. So again, what is the aim of public policy? Is it to ossify something that existed in the past, or does it create the opportunities to innovate out of the problems in the future? So when we come to thinking about what can we do about reducing the global value chain risk, the first point that I would like to emphasize, the chapter makes quite a good claim for this throughout, is that this is largely in the hands of the private sector, so I'm very pleased that someone representing Flexport is here. It's incredibly costly in many cases to change the supply chains. And there's huge investments, it's very capital intensive in some times. So let's say you need to be certainly mindful of the costs that are associated with. Having said that, we looked at the kind of strategies that people were putting forward, and we came through a rough hierarchy that diversifying suppliers is probably the least costly, and maybe the one that makes you more resilient to shocks. Then reshoring, nearshoring, friendshoring, for some products may be suitable. And then the least favorable would be managing stockpiles or inventory management, which only is suitable for certain products. And if you were seeing last week in the European Union that they were thinking about how to make sure that certain medicines were going to be available in the near future. And that's in that kind of debate that there are certain products that you do want to have a stockpile just in case you have that need. So the final part, when we're thinking about what kind of policies do we want to use, I think that the first one is that we've got to accept that often the case is not well understood. What is the role of the public sector in this area? So one part is just actually explaining what is the problem and what can we do to solve it. And the second point there, it becomes really, really difficult when you start talking about things like national security considerations. How do you do that cost-benefit analysis when you've got such imponderables that you nonetheless want to protect? but we shouldn't shy away from actually trying to say something. But the third point is that we should try to identify the policy area of the problem, and be as specific as possible of what we want to achieve. And the final thing is just that there's a danger that these kind of debates can implicitly lead to more protectionist stances. And that will hinder the income convergence that we've seen before, the regulatory fragmentation of the international trading system will also make it much more difficult to achieve our environmental objectives. And finally, it would really make boosting growth in the longer term much more difficult, so that headwind we've been talking before may become stronger than a light breeze. With that, I'll stop. Thank you very much.
All right. Well, first, it's a pleasure to be here. Thank you to the Peterson Institute for having me. Fun topic. I like it. I'll just start with the conclusion, which is this chapter is great. It's a very valuable contribution. It takes a balanced and sober approach that looks at the costs and benefits of dealing with supply chain or global value chain issues. And what is the path we might take to pursuing supply chain resilience, whatever that means. Resilience, robustness, though that's part of what this does well, is it gives some definitions, all too rare. Now, I will note at the beginning, this kind of a diplomatic and scholarly approach also means that the study treats the entire gamut of ideas out there with patience and respect when perhaps mockery is called for, but I figure that's why I'm here. All right, so with such a broad analysis, there's a lot that I could talk about. I'm going to focus on the things that Dr. Sutherland already raised as central parts. I'm going to do this two parts. The first is going to be freestyle. In other words, you can look at me, not the slides. Then I'll actually introduce a little bit of data. First part, I want to talk about what are those potential remedies? What are the things we might do? And the paper takes a very nice, cautious approach. So I'm going to largely be complementing with an E, the part to what's going on. I already did the I. What's going on with the with these various potential remedies, with sort of a bit of an industry perspective, and then the second part, since we're all talking about how we respond to shocks, I'm going to try to look at an actual shock, see what it looks like, and see if it has anything to do with what we've talked about as remedies. So, all right, that's what you have to look forward to. Okay, first the remedies. As this is. We're a remedy for what? You know, I guess there are some professions which like to do diagnosis and then cure. We'll start with cure and then work back to diagnosis. So we know there are shocks out there. We know this is a problem. We sort of take a Potter-Stewart approach to this for when what is a supply chain shock? We know it when we see it. But since we don't really have a good idea what these shocks are going to look like in the abstract, we sort of come up with a range of broad remedies. And the three that you just saw, which is a good set, diversifying, near or friend shoring, and stockpiling. I just want to say a little bit about each one of those to start with. And then I'm going to turn to the question of whether it's government or the private sector that should be addressing these. So let me start with diversifying. I would endorse the statement, which is that this can be very costly. It sounds great in practice. There are substantial fixed costs and economies of scale in the sector. From a freight forwarder's perspective, my company does freight forwarding, you get things like volume incentive discounts for working on a particular trade lane. If you are one of our clients who are trying to set up supply chains, you need to go and vet a supplier. You need to make sure that they sort of meet your standards, that you have to interact with them, and there are fixed costs to those interactions. So it is not a trivial matter to go from one source to two. Companies do this, don't get me wrong, and we put out some data where we sort of show some evidence of ordering from multiple sources and how that's been changing, but it is costly, and there has to be a reason to do it. Of course, there's the other fundamental matter, which is when you initially picked your source, it was the lowest cost per value. And if you're going to start deviating from that, now you're doing something that wasn't the lowest cost per value, so you're increasing your costs. But I'll leave that there on diversification. One of the things I particularly liked in the section talking about near or friend shoring is that it did ponder a bit, do we all agree who our friends are? Because we often don't. That, you know, there's not a transitivity that, you know, if Chad likes somebody and I like Chad, then I like Chad's friend. It'd be nice if it worked that way. It doesn't always, and this does come up in these things when you try to get coordination. Does everybody agree? So we worry about, say, the world splitting into 2 trade zones. It could be a lot more than that if you sort of do who people are comfortable with. The thing that I wanted to focus on here, though, that's a bit different, is the near part. So we worried about what friends mean. Let's worry about what near means. That seems like it should be obvious. You know, which is closer to Los Angeles, Querétaro, Mexico, or Shenzhen, China? Well, Querétaro is as the crow flies, but crows play a relatively small role in delivering global freight. You know, there is flying involved. People do this, but even flying, it gets a little tricky because first, it's a very expensive mode of moving things. It counts for about 5% of traffic. And to make that economically viable, you need to have sufficient volumes that these flights are flying full and you get base load. So even by flight, it probably works out that the heavily frequented route is going to be cheaper. If you get to things like ocean shipping, dramatically cheaper, and then it's much cheaper if you are on a very popular trade lane, like the biggest one in the world, the Trans-Pacific eastbound, where you have, you know, ships running up the Asian coast and then sailing over to often to the US West Coast. So I guess the point on this would be there's been a bit of a presumption in much of the discussion, which is that nearer is cheaper and better. That's generally a flawed presumption, that ocean shipping is generally cheaper than air and certainly than trucking or rail. So it does not necessarily mean that the place that is geographically closest is the cheapest. Let me turn then to stockpiling as the last of the remedies. There's a number of reasons why this can be costly. The paper talks about some of them for things like oil or commodities where there's physical storage, and that is costly, absolutely. There's more, though. If we take one of the sort of celebrated instances in which supply chains ostensibly failed, we can look at things like semiconductors. And you could ask, you know, when all of the auto manufacturers decided, oops, we really did need those semiconductors, why did they not have large stockpiles of semiconductors just waiting for the auto industry to lap up? And of course, in addition to the storage cost, then there's the question of inventory gets outmoded. So if you have lots and lots of last year's or the years before's semiconductor chips, you might be able to sell them at a really big discount, but they may all go for naught. So on top of the storage cost, it is not a panacea to say, let's just pile up lots of these things. Okay, before I get to some data, the last thing, there was a fun discussion in the chapter on who's supposed to do this stuff anyways? Is it supposed to be the government or is it supposed to be the private sector? And it's with the carefulness that characterizes the chapter, it gives 2 conditions for when it might be the government. That's the right answer, which is one, essentially externalities. What happens if the social cost to a shortcoming, to a failure in global value chains is not recognized by the private sector, but is recognized by the government. And the second is where there's an information asymmetry and the government knows more. Now, I was trained as an economic theoretician. That means that I have a professional competence in putting forward highly dubious assumptions with a straight face. But this actually, some of this stuff actually puts me to the test a bit. So let me just take each in turn. On the question of who recognizes the cost more, let's just take as an example vaccine supply. So, and you've got a couple of vaccines out there. I don't know, call them Pfizer and Moderna. Now, from the society's perspective, as long as they're equally effective, and I won't get into that now, but as long as they're equally effective, you're really fine as long as you have an effective vaccine. From Pfizer's perspective, it makes a really big difference whether you have a supply chain failure, because that may be the viability of your business, or at least the success of your business. So the idea that the societal concern is going to outweigh the industry concern seems slightly implausible to me. That for most of the companies that we're dealing with this, you know, they don't, substitution is good for society. It doesn't really help them very much at all. They fail. On the information asymmetry, let me just say I've had the great pleasure of dealing with a lot of very capable government officials, a lot of people who are steeped in supply chains. I can report that there are information asymmetries, but they do not run, they have a different sign. And let me, now, that's a little bit facetious. I will say there is, of course, room for public goods. There's infrastructure and the like. On what we're often thinking, but often the more creative solutions have to do with data and information and how that might flow. The chapter rightly notes that data is costly, that monitoring. There's very little that the government sort of has at hand that would give the kind of detailed knowledge to be actionable in supply chains. There are some rules, there are some initiatives that are currently going on with this, where, you know, if you have, say, an individual carrier, it might see either a surge or a decrease in orders, and you don't know from the perspective of being an individual carrier, is that a market-wide thing, or is this me losing out to competitors? So there is some possibility there for sort of coordination and information sharing. The Department of Transportation and others have been doing this. The Federal Maritime Commission as well has an initiative on these things. But getting that data in a useful form in a timely fashion is not a trivial exercise. It takes a lot of investment at the company level and then some very adroit and insightful work at the government level. So there are possibilities there, but it's not easy. All right, enough theorizing. Let me put up a little bit of data. We've all been talking about how we respond to a supply shock, so I thought it might be fun to look at what a shock actually was and see whether it has anything to do with what we've been talking about. So this is something that my team puts out using Flexport data on how long did it take to get a cargo from Asia to, well, in one case, the US, that's the Trans-Pacific eastbound, in the other case, Europe, that's the Far East westbound, and to get it from cargo ready date to destination port pickup. And so this is designed to give you some idea of how intense was the supply chain crisis to sort of moving containerized goods. And it goes back for about a year before the onset of the pandemic crisis, just so you can see there's a degree of cyclicality. Things do move a bit. And so we establish a norm, which is if you want to look at the Trans-Pacific eastbound, you're in roughly the 45 to 55-day range. There's peak season, there's other things. At its worst, this got up to be around 110 days. And then it backed off sharply, although it's not a complete recovery. That's a whole separate session as to why not. So that was the shock. Where did this shock come from? This made it very hard to get goods. And if you were doing something like just-in-time inventories, this really threw you off, right? This said, okay, time to restock. Wait, 110 days to get that thing? That's crazy. All right. These are U.S. personal consumption expenditures. The sort of reddish-brownish line at the bottom is services. That behaved like you would think in a shock. It dropped and then slowly recovered. The other two lines capture the components of non-durable goods and durable goods. And everything is normalized so that it's 100 at February 2020. What you see is that by the time we hit the spring of 21, durable goods orders were up over 30%. So that's what I'm putting forward as a shock. And actually, we'd still be pretty impressed with the non-durables if it weren't sitting next to the durables, because it ends up over 12%. And you can look to the bit to the left to see this was not the normal fluctuation in any of these things. So even if you had sort of said, okay, I calculated a couple standard deviations, where do I want to go? We've blown past that. Where did this come from? Again, a detailed thing would be, would take more time, but here you have real personal income at the top, real government social benefits as the orangish line, and then personal savings down below. The shocks in demand correlate very well with government transfers. So we'll leave it at that. And then now, I wanted to get to the bit of whether this is a supply chain shock or a supply shock or a demand shock. And so this is what I'm going to put forward as suggestive. Here I've looked at U.S. real goods imports on a quarterly basis. Not hard to tell where the pandemic shock was. There's that nice little V marker that shows you. And what I also did was I projected what had been the normal growth in U.S. real imports up through, I think it's through about through the fourth quarter of 2019. And so how did the supply chain perform? Well, actually, I could have used the previous slide to talk about that, because those consumption figures were goods that were actually consumed. People actually consumed 30% more durables. So this was not that we sort of fell short. And here you can see, so this complements that and says, actually that hump that appears is we shipped goods and imported goods at a substantially faster rate even than the trend. And by the way, it's not a small thing to recover from a dip like that, because people cancel sailings, cancel routes, put things in mothballs and the like. So you could argue that this actually was not, that the supply chain actually performed reasonably well. Not in the sense of everybody got what they wanted when they wanted, but we can take this as a kind of shock and think, well, what should we do? All right, so I'll sort of put this back in here, and just as a closing question, as I said, was that consistent with a surge in was a supply shock, or does it look more like a demand shock? If it's a demand shock, how does one ensure against that? And then we get to questions of capacity versus efficiency. On this also, by the way, I should note, and this will be my last remark, when it comes to should we try this, and should we try things like stockpiling, companies did. Companies, what they did was, as they saw demand shooting up like this, they said, I've got to be ready. I got caught out. I don't have enough in the warehouses, so I'm going to project that this sharp rise that you saw heading into 2021, maybe it continues, and I'm going to project that the slow deliveries continue. So what do? You say, I need a higher inventory to sales ratio, and I'm expecting very high sales. What has the result been? An awful lot of company regret, and a lot of pain, actually, in the shipping industry, because what you've now got is mountains of inventory that people are slowly trying to work off, which is all the more expensive to hold because you have high interest rates. So, again, I commend the chapter. It's great. It's a very good guide to do this. It points out where there's a lot of questions, and maybe I've added a couple more questions to the list. So, thank you.
Okay, good afternoon. It's a great pleasure to be here today. And thanks to OECD and all the previous speakers for very interesting and informative perspective. What I'm trying to do today is to pick up on the last part of these responses or policy, government angle, and then drawn from some of my own experience. As I was introduced, I spent about 30 years in the government of Korea in the area of trade, industrial policy. But I would say the last 4 years of my 30-year career was really tumultuous in a sense that we had to really deal with, first of its kind, all the supply shock and disruption. I would argue that Korea is actually one of highly open middle-sized economy and fully integrated to GVC, exporting, importing a whole variety of manufacturing goods. So I would say that Korea could be a bellwether of what is happening and what is changing in terms of trade patterns and also supply chain this pattern. And for the last 4 years, I mean, we experienced a really big nationwide the supply chain shock. For example, first in 2019, all of a sudden Japan imposed these export control measures on 3 key chemical components, which is essential to the semiconductor manufacturing. And in fact, 2 Korean companies, Samsung and SK Hynix, were depending almost all of this supply for the supplies on the Japanese companies. Second, 2022 mask. I mean, it's not just specific to Korea, but throughout the world. 2021, there is this urea, the kind of commodity material called urea in Korea, which is used as a diesel exhaust fluid. And all of a sudden, China introduced export restriction on urea, and that it caused huge shock in Korea. In fact, there are a handful of companies who have imported more than 95% of total supply from China. And then when China imposed this export restriction, the market panicked, and then we came to a situation where matters of days, like tens of thousands of trucks and buses could just grind to a halt which caused huge political the backlash as well at that time. 2022, I mean, it's also global, the Russian invasion of Ukraine, but in particular to Korea. The semiconductor companies imported about 20-30% of these rare gases from Ukraine and Russia. So through these four big supply chain shock and disruption, I think that the Korean government, as well as these businesses, began to really recognize the real threat and the risk involved in this over-dependence on some of these vulnerable product. And actually last week, there was a report in Financial Times and other outlets that China imposed this export control on graphite. I'm not an expert on this, graphite, but we all know that this is critical, the mineral, which is essential for the EV batteries. And then now these Korean companies, they are building almost 70% of all the new capacity being built in the United States. But in fact, the Korean companies are importing more than 94% of this graphite from China. So what is going to happen? Is it going to evolve into another big supply shock, or it could be more managed well? I think it remains to be seen, but I think it would be helpful for us to think through, through these kind of real supply shock disruption cases about what government can do. What is the role between government and the private sector to prevent from this kind of supply shock from happening, but also when such crisis hit, how to cope with this crisis. So I think we can think through these kind of real cases. I mentioned that I think some of shift or changes are happening in the supply chain in relation to Korea. This is the Korea's export to the US and China, the proportion out of this total export. And then this red line is the China, Korea's export to China. The blue is to the United States. And what is interesting is for the last 20 years, Korea has really ride on the rapid growth of China. And then China remained as our #1 trading partner. Since 2010 or so, almost a quarter of our trade portfolio was coming from China. And on the other hand, Korea's traditional ally, United States, it was just half of that, the ratio. But what is happening is from 2017-18, during this, starting from this pandemic, but really accelerating through post-pandemic era, our portion, trade portion with China began to rapidly decrease. I mean, of course, there are cyclical aspect, slowdown of Chinese economy, but obviously there's a structural things going on in here. And I would argue that the government, as well as the business sector, began to realize over-dependence on one or two countries in some of these vulnerable sector could be really risky to their business. And they began to change their behaviors and decision. So from this angle, I would provide 5 the key policy consideration or lessons from my own experience. First, market failures happen in reality, and policy responses should be agile and measured. Going back to this urea case that I mentioned, obviously there was a market failure. Of course, I mean, as I said, about a handful of companies were importing this urea from China. When the crisis hit, I mean, none of these companies were prepared to find alternative sources and then really, to activate their contingency plan. So at that time, there was really pressing need for the government to intervene to really find alternative sources of urea to prevent the tens of thousands of trucks from stopping any moment. Imagine in this era of online shopping and all these logistics for export and import, if all these trucks fleet could stop, I think that could lead to really political crisis. So I would say that there's no question that there's a role to be played by the government in this kind of situation, but the question is to what extent and how the government can react to prevent another government failure from happening. The second, develop systematic supply chain policy on strategic sectors. Let me go back to this urea case again. When the crisis hit, as I mentioned that the private sector wasn't prepared, but the government wasn't prepared as well. So we didn't know where are these alternative suppliers could be. And then, so I think we had to, the waste initial kind of critical time, wasting, trying to figure out at that moment, which was very, very late. So the lesson from here is that in the normal time, you have to identify this critical, the goods or critical mineral, for example, critical mineral. And then you have to do this mapping exercise and then see where the weak linkage or choke point are, and what are the countries you can collaborate with in case of emergencies. And then develop some sort of a cooperation network or framework with those countries. And then also you have to develop this monitoring. On a regular basis, you have to constantly communicate with the private sector to really catch early symptoms of any crisis. And then when the crisis hit, you have to really be agile and determined to cope with this crisis. And this strategic stockpile is one of the the example. I mentioned this graphite case, which emerged from last week, and Korean government, for example, they announced that normally Korea identified 33 critical minerals, and then they among all these critical minerals, they choose key critical minerals, and then this accumulated stockpile at least 54 days. But for more critical, this critical mineral, they decided to extend it up to like 100 days, for example. Obviously, will take a lot of public finance, but I think considering the huge risk involved, I think it could be a reasonable policy option. Thirdly, the private-public partnership is a key feature. We talk about always this partnership between private and public sector, but I would argue that in this case, the nature of this partnership is really different from previous, because in this case, private sector is just not one of many, stakeholders or collaborators, but they are the main one. They have to provide this critical information and then let the government know any early responses from the market. But also there's this tricky issues of privacy and the proprietary information, business secret. For example, in the middle of this the pandemic, the United States and the whole world were suffering from this shortage of semiconductor. And at that time, U.S. government, they pushed forward this kind of the request for information from the private sector in the semiconductor, requesting information about their client information, and then how many stock they are holding, and then supply and demand. These are all very, very kind of sensitive information to these companies. So at that time, actually, the Japan, Korea, and Taiwan, those government had to raise issues with the U.S. government, and then kind of find reasonable ways in which to collect this information from the companies. First, I think I'll really emphasize this importance of international cooperation framework because in the previous case of this urea, for example, and this graphite, I mean, none of countries can just cope with that on their own. So that's why it's really important to develop more systematic and the more sustained international cooperation framework. We have G7, and then we have APEC, etc. But not just talk shop, but some more sort of a sustained framework would be needed. So in that sense, right now this IPEF, Indo-Pacific Economic Framework, negotiation is going on, and they announced the conclusion of the supply chain pillar a few months ago, and then there's a lot of debate whether it's strong enough, it is binding enough, but at least from my perspective, this is a good starting point. And how to design the supply chain. And I think that many of the substantive aspects needs to be made more concrete and materialized through this implementation phase. And I think this graphite case from China, I think it's a good, a good opportunity to just put to the test, what IPEF is trying to do. So I'm really interested to see how, all these government involved to react to this graphite, these export control measures by China. And then economic cohesion, I think this is really critical. For example, Korea, Japan, and some other countries, they experience this unexpected, the economic cohesion. And also, how to collectively respond to this economic cohesion. I think that would be really important to prevent this crisis. And this is, the fifth point is more kind of the medium or longer term, but obviously industrial and trade policy can help diversifying the supply chain. For example, Japanese government, I think in 2020, around that time, they decided to provide the Japanese companies in China to provide the subsidies to the Japanese companies in China to be relocated to, for example, Southeast Asian countries. And we have to investigate how that policy became really effective. But I think at least those policy measures the government can utilize. And I think in the report I agree that trade itself doesn't cause this vulnerability. I think this over-dependence on certain a small group of countries in critical goods and material, that could cause a problem, but trade itself is not causing this vulnerability. And so trade diversification can lead to the supply chain diversification. For example, Korea, we face the trade dependency out of our GDPs is 70 or 80%, actually one of the highest. And then what Korea is pursuing is not to cut ourselves from this trade network, but try to expand more into diverse regions. If we had focused on China and US before, then now we are trying to pursue the Latin America, Middle East, Africa, etc. So, and then lastly, this IRA. I think IRA is also one of the big this industrial policy and subsidy program. And then the one missing link that I find is that there's this kind of misalignment between its goal, which is diversifying this critical mineral supply chain, but also its incentive scheme, because the IRA just limit the tax incentive to only FTA countries of the United States, which is very limited. Right? So as we saw from the graphite case, China is almost about 60% of production in the world, and then we need to find a way to diversify to other, the resource-rich, mineral-rich countries, and then I think IRA could play a role. Yeah, so I'll stop here. Thank you.
Well, good morning, everybody, and thank you, Douglas, for that. For a very interesting report, and then for the presentation. I'm playing cleanup batter, so I'm going to talk a little bit about my colleagues' contributions. We've had a rich discussion, and there's just so many facets to supply chain adaptation and adjustment that sometimes it's hard to get a little traction on one particular area. So I'm going to try to just provide a little bit of overview and then move into a topic that I think we might cover a little bit more, which is friendshoring, so-called friendshoring. So Douglas began by really laying out three things. How are GVCs being reshaped? Why are they being reshaped? And here risks really, and particularly risks coming from overdependence or vulnerabilities, played an important role. And lastly, the implications. And I think we had both Phil and Hung-Koo really filling in some on the implications. Phil, as always, fun and fascinating presentation. But one of the things you said really struck me as so true, which is, are we starting with the remedies and then working back to the problems? And I think this has been a frustration for us as analysts in thinking, where's the mapping between the problem and the solution? We don't have that yet. And yet governments reacting to the real risks that emanate from these supply chain disruptions have rushed to solutions. Hung-Koo really reminded us that the vulnerabilities are real and they have real consequences for people and for governments. And that those consequences can be clearly termed crisis. And he gave a nice example with urea. He talked about really crisis management and the need for cooperation across countries. But we also know that governments want to act proactively. They want to prevent as well as deal with a crisis when it happens. And in both of these cases, trade has got to be part of the solution. Hung-Koo talked about how cooperation in response, particularly to economic coercion, can be effective, but we are still just at the beginning of trying to make those agreements. And he's optimistic. I really appreciate that in a colleague who sees some of the good that's being done, as well as some of the risks and failures, and how he emphasizes trade as a solution. I do want to point out one thing that goes back to Phil's comment about mapping remedies to problems rather than problems to remedies, which is that not all problems are alike, even when they all emanate with, or China is part of them. So in Hung-Koo's career, he's had to deal with these enormous supply disruptions. But let's just take personal protective equipment. We know that there was a shortage of PPE in the United States, and that shortage really led to these heart-wrenching outcomes where, you know, our frontline workers didn't have the protection they needed. And in fact, some of them died from infections that might have been prevented if we had adequate supplies. We have rushed to blame China, despite the fact that it was really a global demand shock for PPE. And Chad Bown, who's our moderator, has clearly laid out the trend in exports from China to the rest of the world in PPE. And they show that China returned to its normal exporting pattern, really exceeded it by the end of 2020. And I think that in some sense, you know, saying it was a China problem just ignored the fact that it was really a demand shock. Would stockpiling in this case have made sense? Probably, because probably paper masks don't get outdated very quickly and aren't that expensive to store, but, you know, still, China's the problem. Then look at some of the other cases that Hung-Koo mentioned, where clearly China is the source of the problem. And then others, like the recent graphite, where China is the source of the problem, but the source of the problem may go back earlier to our own export controls. So China is clearly mixed in to almost all of these shocks, but how we respond to them has to relate a better understanding of what the true shock is. So let me just talk a little bit about the role of friendshoring. And I'm calling it friendshoring because that's the terminology, but what I really want to make is that diversification seems to me to be at the heart of the remedy, the answers to almost all of these problems. I look at reshoring as a form of diversification. I look at friendshoring as a form of diversification. I look at de-risking as a form of sort of free-form diversification. Just get it out of there. Where it goes, we don't care. It could go to another concentrate. It could be concentrated in another country. But nevertheless, it's in some attempt at diversification. So we need to match solutions to problems. So I wrote this way before Phil came today. And it looks to me like, national security may demand a certain degree of self-sufficiency. We may say we just have to have it on shore. That certainly seems to have been the U.S. conclusion with semiconductors and with EV production, maybe stockpiling, but also clearly reshoring for some cases. There may be that our economy is too vulnerable to natural shocks. So this might be hurricanes or tsunamis happening in particular parts of the world. Diversification of supply would be the answer, perhaps. Or our economies are too reliant on unfriendly sources and therefore vulnerable to economic coercion. Clearly, then de-risking. Can't have all our eggs in that one unfriendly basket. Well, where does friendshoring come in? Well, friendshoring is highly problematic in my view, and yet it's really very important that we talk about it because it provides both diversification and de-risking at the same time. It embodies the realization that moving away from reliance on China requires more reliance on middle-income countries. And I'll go farther and say it requires more reliance on a small set of middle-income countries. And this is where we should be focusing our attention. Is the word friend and friendshoring clearly defined? Absolutely not. And we already know the trouble with limiting it to even like-minded. Is that democracy? Is that views the Ukraine war the same way we do? We know none of those are going to be adequate to dealing with the immense need for diversification. So I just put here a quick chart that I've been working with, trying to think about reshoring, de-risking, and friendshoring, trying to think about how governments are moving forward. And here I'm looking at the kinds of policy tools that are being used, and the US in particular has been very active in all. Now the EU is moving this way as well. How effective are these policies at achieving their objectives and how costly? If we just look at reshoring, of course, we know they can be highly effective. We've seen a tremendous response to the CHIPS Act, lots and lots of new investments being announced in semiconductors, R&D, et cetera, in the United States, but it's incredibly costly. And when it comes to reshoring, we know what the attraction is. Governments can claim that they're creating jobs. But we also know that it's self-limiting. Why? Because there's only so much that the government is going to be able to afford or borrow to afford. So we've got a problem. It's attractive to voters in some sense, but it's also can only be used a few times. And it's, of course, highly problematic. It's not compatible with other goals that the U.S. has, such as, preventing a global subsidy war or trade or tax competition, and, of course, violating WTO norms against domestic content rules. What about de-risking? The U.S. really actually undertook already a very big exercise in de-risking, which was the Trump-era trade war taxes. That's why we see the big decrease in U.S. reliance on China. Was it effective? It was moderately effective because it's not just how high the tax is, it's also the response. We heard earlier about fuels. We talked about how fuels can increase $1 or $2. I believe it was Swami who talked about this. And still you don't get the response because you have very inelastic demand. And so the trade taxes were effective in moving some supply chains, but others, unfortunately, which ones they moved had nothing to do with the policy goals. Nevertheless, it was moderately effective in reducing our overall reliance on China and moderately costly. Clearly not no cost, since most of those tariffs burden was passed through to U.S. firms or U.S. consumers. And of course, highly problematic, violation of non-discrimination norms in the WTO and quick rupturing of global value chains. On friendshoring, here, so far, we've had an emphasis on development of common standards and cooperative agreements, some discussion about cross-border investment, but very, very light. Has it been effective? I don't think most of us think it's effective. As it is, Hong Kong has convinced me it's a good start. but we all believe that a lot more needs to be done. So far, it's been very low cost. We know that successful IPEF agreements will not be sent to Congress because they don't involve budgetary outlays. No, small cost, small gain, in my view. But it has some favorable outcomes. It encourages higher standards in countries with whom we want to partner. That's a good thing, particularly if we have the patience to allow these countries to develop into these higher standards. And it is discriminatory, but not necessarily as discriminatory, perhaps, as one might necessarily think. We can embrace at least the major countries that are likely to be able to serve as alternative sites for GVC production. Where will friendshoring happen? As I mentioned, we have a very limited set of countries that are ready to provide alternative sites for GVCs. These countries are largely low middle income countries in Asia, plus Mexico for the United States or Eastern Europe for the EU, but largely we can list them very quickly, maybe 10. The reality check, however, is that China will remain part of all alternative production site supply chains. We've already noted this repeatedly for Vietnam, where much of the new supply is coming from Chinese-invested factories in Vietnam, but we're also seeing it increasingly in Mexico. Just this week, a large Chinese project has been announced developing an enormous production site just over the border from Texas in Mexico. That will come in 3 parts. One is for GVC production, another is for logistics, and lastly for business services. China is going to remain a part of global value chains. What shape will this exposure to China take? What shape are we willing to tolerate? Imports of most IPEF countries have become less diversified. Abby Dahlman and I released a blog post recently on this, looking at the concentration of both imports and exports of all countries involved in the IPEF negotiations. We see since 2010, all of the IPEF countries have become more concentrated in their importing and exporting patterns, except for little tiny Fiji, and then Japan and the United States. The United States has particularly benefited from the Trump-era tariffs in terms of reducing its reliance on China. Most IPEF members have not only increased the concentration of their imports, but they've become more reliant on China. So when we dig deeper into the data, we see that the #1 partner with whom they've become more reliant is China. And here we have a new PIIE chart that will be coming out this week, looking at all of the IPEF countries and looking at their increased trade, China's share of their imports and exports since 2010. And you can see that most of those lines go up. The import are the blue lines, exports are the red line, and particularly on the blue line, we see an increase in China's share, in some cases dramatically so. So what do we do in a world where China is deeply embedded into supply chains? Here's another picture. This is just world trade in intermediate goods excluding fuel, and you see that China provides about 15% of global trade in intermediates. Other countries here, I'm looking at low middle income Asia, upper middle income Asia, upper middle income North America, primarily the star there would be Mexico, and you see that except for low middle income Asia, and in particularly Vietnam, there has been very little movement. Okay, so is de-risking really happening? Hung-Koo has showed us that it is happening in South Korea. We find that it is happening in Japan, mainly for high labor intensity goods, however, so not in things you might think of as critical. And then it's happening for the US, but again, in a very scattershot way due to these scattershot tariffs. But developing countries are not de-risking from China, whether defined as diversifying just in general or reducing reliance on China. In fact, they've spent the last 15 years moving in the opposite direction. The important point is that we are linked to them. We are looking to them to be an alternative sites for Chinese production. Why? Because obviously we're not going to produce everything ourselves. Trade has to be part of the solution. Lastly, Chinese investment is moving into alternative GVC production sites, making supply chains longer and less transparent. So what are the policy implications? I think now is the time to clarify the scope of de-risking. Which sectors and which critical inputs. We have to get real about the fact that we cannot deal with everything at once. We have to go for what's the most important. What can be friendshored rather than reshored? The answer is going to be most everything? And then what is an acceptable role for China in these revised supply relationships? I would argue, at least here in the United States, it's a question that we've been avoiding. I've been just writing a piece with some folks in Asia, and it's the #1 question that they have. So while we may be avoiding it here, it's clearly of primary interest to the countries that are going to accept their new role. The U.S. is beginning to lead, mainly by promoting cooperation and common standards through the IPEF and other initiatives, but we all know there's a danger of backdoor protectionism, particularly in asking for much higher labor and environmental standards, and depriving developing countries of their ability to compete and upgrade. We have to remember, again, going for growth. This is a primary concern for developing countries. We speak to them when we speak to that objective. And lastly, there's an urgent need to facilitate private investment. All panelists have already talked about the fact that it's the private sector that creates, governs, moderates global value chains. But governments play an important role in setting up the conditions under which those GVCs thrive. And that could be through infrastructure investments, better rules, trade facilitation. There's a lot of ways in which governments play a role of setting the stage for GVC reformation. Clearly, we have to talk about aid, loans, loan guarantees, and other assistance to developing countries. If we want it to happen, we're going to have to put some skin in this game to get the type of diversification with the kinds of countries that we want to see. Thanks very much.
Okay, thanks to everybody, the panelists. They were all fantastic. We're a bit over time. And so what I'm going to do in about 2 minutes is to pose a couple of questions, and then I'm going to turn it over to the Peterson Institute President Adam Posen to wrap things up. But I have a couple of questions for Doug, maybe for Phil, for Hung Ku. I appreciate Mary's comments as well. She stole some of my good questions, so, or what I thought were good questions. You're not going to have time to answer these today, and we're not going to have time to bring you up to the podium to answer them. So I want you to think about them. And then maybe write down answers, and we publish things here at the Peterson Institute, and so these are things that came to mind. Douglas, let me start with you. So you mentioned national governments and policymakers. Phil mentioned or brought up the really, really big and important question about when it comes to these issues of supply chain vulnerabilities, should it be the private sector doing it, or should it be governments doing it? And I guess that gets to the underlying issue of, do firms face all the right incentives? Are there social objectives out there that they aren't internalizing? And if we go to this puzzling example of the automobile semiconductor supply chain shortage experience, what happened there, and I don't disagree at all with how Phil characterized it, and yet what I think we saw happen there was when automakers across the industry were caught short on chips, it was workers who ended up getting furloughed at the plants, and the shortage of cars led a lot of these automakers to make supernormal profits. So they didn't really suffer. If anybody suffered, it was maybe the workers and consumers who couldn't get vehicles. But so is that what's wrong with that? Or is that just a one-time shock, we'll never see it again, so we shouldn't worry too much about it? Or are there situations in which there is this divergence? Doug, you speak most closely with these policymakers out there. Are they saying things that they're seeing divergences between what policymakers need, what society needs relative to what's in the private sector's interests? Phil, for you, you mentioned informational asymmetries, monitoring is costly, and the like, and I am completely on board with you there. You've been in government. You know the limitations firsthand of what government policymakers have access to in terms of information. Now that you're on the other side, and you get a lot more data and information in the private sector, what should we do about that? You I think, alluded to some ideas on creative data initiatives. How can we do that? Are there ways to share data between the private and public sectors? In normal times, I think clearly, we wanted more cooperation in the abnormal times of the pandemic so the policymakers could learn about the disruptions and how they could help. and how they could warn the public about disruptions that were coming, maybe other firms you mentioned there. Hanggu mentioned initiatives, policymakers across countries now talking about this in the IPEF context. Should this be brought in? Should there be not only better information sharing between the private sector and government, but between government policymakers across supply chains, since these supply chains cross borders? And what do we need to do to keep business information confidential and yet provide policymakers with additional information that they can use to help act on it? And finally, Hanggu, you showed us Korea's exports to China falling. Mary showed us everyone becoming sort of more dependent on China's imports. Doug showed us a slide with U.S. import share from China decreasing by, I think, 5 percentage points or so. In Europe, kind of moving in the other direction, right? So I look at that and say, well, and combined with Mary's results, by the U.S. taking actions, and maybe countries like Japan with their China exit subsidies, countries that are just standing by and not doing anything, not only are they not de-risking, they're getting riskier, not by their own accord, or things are changing. So I would have asked you if we'd had time, what are is the government of Korea seeing that? And what are some of the policies that they're engaging in to try to mitigate some of the risks themselves? It seems to me that you have very few options if you're a government policymaker. You can choose, you need to do something discriminatory, something like a tariff or a subsidy. Tariff is really obvious, and that's likely to lead to retaliation and political blowback, whereas a subsidy seems to be a bit more diffuse, even it's really designed to deal with the risk from one country, maybe is more politically feasible. In any case, lots of questions, lots of work to do. Again, I want to congratulate the OECD for really launching this project and making such a major contribution, but still I think it's really only a first step. We still have a lot to learn. Thank you.
So Chad, as usual, manages to cram a huge amount of substance in, as did all our speakers today, and as is the Going for Growth Report 2023. If we were in old days, I'd hold up a hard copy. Instead, I will remind everyone that the speakers' presentations, the link to the actual report, which is available for free download from the OECD, and all that is available on the PIIE.com website. There's an events page for Going for Growth. We hit on two of the most important issues. It is a pleasure to be able to draw on friends in the private sector who bring their own perspectives, as well as our colleagues at the OECD. Structural reform is a term that got bandied about for too long and is, unlike, say, neoliberalism or the Washington Consensus, deserves the bad rap it got. But reform for growth, going for growth, remains a worthy aspiration, and that the OECD Economics Department and the research teams have done so much work about trying to move this forward in a way, this being going for growth, in a way that is consistent with keeping the world from fragmenting further, in a way that is consistent with the transition that we need to make that's green, is a great vision and a great contribution. So thank you very much. This meeting is adjourned.